Hey, good afternoon, everyone. This is Mark from Right Line Trading. We have about 3 minutes to go. Just want to let you know we're ready to go, and just hang in there. A lot of people are coming into the room, and we're going to be starting promptly at 1 o'clock. Okay, Mark, it's doing great today, and we are cashing in on it today in a really nice way. I'm just going to open the questions box and make sure that everyone can hear me. So if you could hear me, if you could put a yes in the text box, I'd really appreciate it, just to ensure that everyone can hear my voice. Okay, great. Thank you all. Now, what we're going to be discussing today is a very unique strategy for creating credit spread positions. It is probably a strategy that you've never seen before, and it's one that's just right out of the gate. It's banking us between 75 and 80% winners, and then I'm going to show you how we can take a losing trade, that 1 in 4 to 1 in 5 trades, and how we can, using a very fixed formulaic strategy, turn that position into a winner. We've done it once before on Lockheed Martin, and we're doing it right now on Matador. Now, just a quick disclaimer that all signals and trading opportunities that we provide are for educational demonstration purposes. We're not licensed money managers, and I would advise everyone to never trade more money than you can afford to lose. Now, this is just the Right Line Trading team. It's growing, and I'm just proud to be a member of it. And I just wanted to acquaint you really quickly with myself. I graduated from an Ivy League university. I went to the University of Pennsylvania for 8 years, and I graduated with a degree in applied mathematics. After I graduated summa cum laude with honors, I was inducted into the Phi Beta Kappa Honor Society, and it was always my goal in as far as my career is concerned, to go into teaching and research. I applied to a number of academic institutions and wound up taking a full-time professorship position at Thomas Jefferson University in Philadelphia. I wanted to stay in Philly. I had a lot of friends there. So I just wound up moving from West Philadelphia to Center City. While at Jefferson, I published 15 peer-reviewed articles in top-tier journals. I taught an enormous number of undergraduate and graduate students. I've always had the mindset of a scientist, a teacher, and an academician. That's how I developed this credit spread strategy. I've been an invited speaker in many cities domestically, in many countries internationally, and I believe I've mentored close to 30,000 traders, many of them in groups, some of them one-on-one. Now, I kind of put this in to show you that those that can do and those that can't do teach. You know, it's an old saying. The full saying is those that can do, those that can't do teach, and those that can't teach gym. That's how it goes. But what I'm not going to do today is sell you a 7-part video series and just dump this off to you and make it profitable. I'm going to teach you how I do it. We're going to be giving periodic academic teaching sessions, and I'm going to provide you with all the trades, and I'm going to spoon feed them to you. I take them myself. Now, that is very, very rare where the person who writes this newsletter up, and I do, you know, our flagship newsletter comes out on Sunday night, and then I do multiple periodic updates throughout the week. And it's very rare that the person that writes them up takes the positions that they're offering to you. Now, if I'm going to offer them to you to trade, why should they not be good enough for me to trade? So it should proffer in your own mind what I believe is the validity of these trades and the power of the trades, because I make great money on them. Now, jumping between strategies instead of focusing and mastering on any particular one is an enormous mistake. And I've seen webinars where they give you, I don't know, 15 different option strategies, butterflies, iron condors, just a huge array of strategies. I'm telling you, I am not a big fan of spread trading. I don't like trading credit spreads. The one of trading debit spreads, I'm sorry. The reason I like trading this as one of the tools in our toolkit is the reason I'm going to show you. But in general, it's my predisposition to simply take a call or a put position if I think it's going to make a nice move. And you wind up making a lot more money. And if you actually configure the trade based on the option metrics, you're going to pay just a little bit more for the naked position than you would for the spread. And you have no upside cap on your earnings, and your downside is still capped. So, you know, it's sort of my personality and my predisposition to not take a spread trade, but selling credit spreads is a very, very lucrative endeavor if it's done right. And when we get that 1 in 5 loser, the way we manipulate it and roll it back into a winner is really unique. Now, not all strategies are friendly to small accounts. Now, if you want to trade this, you can easily trade it with just a few $1,000s. If you want to have the ability to completely configure every trade, and this is going to really go to our occasional loser, you're going to need more money. You're going to need about $6,500 in your account. But that's a component of the trading in which it's not necessary to make a really nice profit on our trades. Now, we have to treat options trades a lot like stock trading. We have to meticulously manage all our open positions. We have to only trade liquid positions, and we have to consistently utilize the same metrics and the same strategy. Our strategy has got to be cookbook. It's got to be formulaic. You can't keep changing your strategy every time the market conditions change. Now, you may change the type of trade that you take, but the strategy that you use to engage the trade has got to be extremely straightforward. Now, why learn to trade credit spreads? Now, the reason that you do, and the reason I find them so helpful in this market, particularly, this is a very, very choppy market, is that you can make money if the price of the underlying stock increases, decreases, or optimally doesn't move at all. Now, if you buy a call or a put position and the underlying stock just sits there, you're going to take a full loser. But if you sell a credit spread, either a bullish spread or a bearish spread, you're going to make 100% of your net credit. And obviously, you have a limited loss potential. You're never going to have to worry about the trade blowing up. You know exactly what the risk to reward is on every trade. And the strategy is super simple. We're going to take two primary credit spread strategies. One is bullish, one is bearish, and they're identical. So learning how to trade these are really, really very simple. Really, sort of the magic sauce in this is finding the best stocks to trade, the ones that provide us with a huge credit when we sell the spread. And that's what takes a lot of work. Because when I sit here, I was already sitting here this morning going through stock after stock after stock, looking at the net credit that we would accrue if we sold the spread, and just discarding one after the other because they do not have enough intrinsic volatility. Now, you may think that stocks have only two directions. They go up or they go down. But the fact of the matter is that stocks have 5 directions. And that's a really important thing to know. Now, a stock can simply move sideways in consolidation, where it really doesn't go up or down more than 1 or 2%. That's an intrinsic harmonic. And it's going to stay, for the most part, flat within a very tight consolidation channel and not move up and not move down. If we've taken a credit spread on it, we're going to make a lot of money on a position like that. Now, if we believe that the stock is going to be mildly bullish, that's when we're going to sell a bullish credit spread. If we believe a stock is going to be mildly bearish, that's when we're going to sell a bearish credit spread. Now, if we believe the stock is going to launch to the upside, we're going to buy a call. And if we believe the stock is really going to take a nosedive, we're going to buy a put. Now, in this particular type of market, we do get big moves in tech, but they're very, very hard to predict. And that's what makes them so dangerous. But that's going to be our strategy. We're going to look for stocks that are trading in consolidation, are going to have somewhat bearish predisposition, somewhat bullish, somewhat bearish, and we're going to wind up making a lot of money on them with very little movement in the underlying price of the stock. Now, selling spreads is really, as we all know, the market is simply an auction-based instrument. Now, I've heard a lot of people say that the market is random in the way that it moves, and nothing could be further from the truth. Nothing that takes place, and I see questions, and I'm going to answer all the questions at the end, because it may be that the question you're asking I may answer as we go further, but I'm going to go through all the questions, so don't worry about that. So everything that happens in the market is based on a collective set of forces that come to bear on price. It's our ability to using the forces that we've defined, be able to predict out into the future the direction that price is going to move. Now, the question is, when we buy a spread, whether we're mildly bullish, mildly bearish, or we believe the stock is going to move simply in a tight consolidation channel, when do we want to be a buyer and when do we want to be a seller? Now, I've heard, I must have seen 100 emails telling me that if you're smart, you only sell options. And that couldn't be further from the truth. The fact is there's a particular time when you sell them and there's a particular time when you buy them. Now, picture yourself sitting in an auction and they're bringing an item up to the podium and they're going to auction this item off. Now, you have to ask yourself, when do you want to be sitting in the audience and you want to buy the item? Or when do you want to be the auctioneer with the gavel selling the item? Because that's going to determine exactly what we're going to do. Whether we want to buy the calls, whether we want to buy the puts, whether we want to sell puts or buy puts, buy calls or sell calls, based on what we perceive the value is. And here's how we look at it. We want to buy when the cost of the option is cheap. Now, usually the value of the option itself, obviously there's a lot of components to it. There's how much time premium you're buying, and there's other Greeks, but the major component that we're looking at is intrinsic volatility. When the volatility priced into the option is exceedingly low, the market is saying to us that they don't believe that the price of this particular instrument is going to make any kind of major move. So we want to be the buyer or sitting in the audience when the option price is really chintzy, because that's what optimizes our risk to reward. We have the potential for making an unlimited upside or on a move, on a long move, an unlimited amount of money on a short move, and the purchase price is really small. We want to sell when there's a lot of inherent intrinsic volatility. We want to stick that to someone else. That's when we want to be the auctioneer with the gavel, selling it to someone in the audience and let them take something that's very expensive off our hands. And it's very, very easy to determine whether the cost of an option is cheap or the cost of an option is expensive. And I'll tell you, all you've got to do is look at IV, intrinsic volatility, as part of the metrics that you examine when you go over the option spread. Obviously, you're going to see the delta plays a big role in what we do, but intrinsic volatility is a major component of what we trade. And when the cost is low, intrinsic volatility is low. When the cost is high, usually intrinsic volatility is high. And when the cost is high, we're dumping them off to somebody else. And as I had said, when the cost is low, implied volatility is low. When the cost is high, implied volatility is high. So to give you an example, as you approach earnings, an earnings report. Now, I have taken a couple of trades into earnings, and have done extremely well with them, but they're very risky. But implied volatility is really high. So you're going to get a tremendous amount of credit when you sell the spread. And if you're right, you're going to get to keep 100% of it. Because after earnings, what happens to the implied volatility? It just deflates. And simply by the price of the stock staying right where it is, your spread decreases in value, which is exactly what you want. You want to buy it back at basically nothing, so you get to keep all of the money that's been credited to your account when you close the position. So we're really, a lot of people call these time spreads because time is on our side. As time proceeds, theta is going to decay the value of the option. So actually, as we move closer to expiration, that works for us. But I like to call these volatility spreads because we're going to look for trades that have, or stocks that have a very high intrinsic volatility. That's going to inflate the price of the option, and we're going to leverage that to get a really nice credit on the trade. Excuse me, I just wanted to get some water. Now, our anticipation, maybe it's earnings, maybe it's time. We don't know, but we believe that an arrow is headed for that stock, and it's that bubble. And when it hits, there goes all the volatility. It leaks out of the option spread. And since we've sold it, the value of both legs of the spread diminish in value significantly. So the amount of credit that we're going to get to keep on the position we sold is really going to start approaching that 80 to 100% metric. And that's where we want to be. So we're not really beholden to the underlying direction that the stock moves as much as we're beholden to volatility on the spread and the fact that time is on our side. Now, obviously, if we're slightly bullish, we only have to have the stock move up 5 cents, really only a penny, because we're going to take a 50 delta spread. If we take a slightly bearish position, we only need the stock to go down a penny, and we're going to get to keep 100% of our credit. So we don't need much of a move on the underlying stock to wind up making a lot of money on the position. So these are all the metrics that I look at when I'm going to formulate a trade for everyone in my service and for myself. Obviously, I'm going to decide on a direction. Is it going to be bullish? If it is, I'm going to sell a put spread. I didn't put it in, but if I'm bearish, I'm going to sell a call spread. I'm going to look at the expiration date, which is critical, the 2 arms of the trade. We're going to sell 1 put and buy 1 put. I'm going to look at the premium width, the premium percentage, and the IV rank, which is critical. Now, I'm going to go over all of these with you because I want you to understand how we trade and what we're looking for. Now, a credit spread is a simple option strategy, and it's constructed by selling an option and buying another option at a further strike with the same expiration date. So a call spread in which we sell 1 call at 1 price and we buy 1 call at another, that's bearish. A put spread where we sell 1 put and we buy 1 put at another price, that's bullish. Now, here's really the sort of the magic to the trade. Now, we're going to look for and this is sort of the constraints on picking a position because it has to adhere to our recipe. It's got to comport with all of our options metrics. And sometimes those are very, very difficult to pull. But I'm telling you, they're out there. And if I spend enough time looking, I can always pull at least one really, really advantageous position. Now, we want 45 days to expiration. And there's a lot of reasons for that I'm going to talk about. Now, if we're bullish, we're going to sell a 50 delta put and we're going to buy a 25 delta put. If we're bearish, we're going to sell a 50 delta call and we're going to buy a 25 delta call. And we're just going to do that over and over and over again. So we're buying at the money puts if we're bullish, and at the money, actually, we're actually selling at the money puts if we're bullish, and we're selling at the money calls if we're bearish. And then we're buying the 25 delta call or put. Now, you're going to hear people tell you that they make 80 or 90% of their trades will evolve into winners because they're going to take deeply out of the money spreads, where you're going to get a potential reward of 10 cents with a risk of 90 cents. That's a 10 delta spread. A 20 delta spread essentially is going to give you 20 cents of potential profit on 80 cents of risk. And that, I'm telling you, is a recipe for disaster. If you try it, you're eventually going to blow your account up because you're going to get 8, 9, 10 winners in a row, and then you're going to get 2 losers in a row. And when you get 2 losers in a row, it's going to destroy your trading account. Now we're going to look for a width of at least 33% between the 2 strikes. And what I've been doing is looking for a width of 40%. And I found one yesterday with a width of 50%, which is really, really unheard of. I don't know what it is today. That's what it was last night. I have to recheck it over tonight, and I'll tell you what it is. Now, it's a little bit of a riskier spread because it could make a really strong bullish move, and it always has the potential to make a bearish move, but it's a great stock, and even if we take a loser, I'm telling you we're going to roll it right back into a winner. We want to get a great risk to reward, and we're going to get better than 33%. Now, I wanted to show you how the trade is configured. Now, here's McEwen Mining. And McEwen Mining, we made 80%. Now, I closed the trade. Our potential net credit per spread was 45 bucks. Now, we're going to risk $55 to make $45. That is an outstanding risk to reward when you sell spreads. And what we did is we sold the $6 put and we bought the $7 put. The $6 put was the 50 delta. The $7 put was the 25 delta. And we received $45 of premium in our account for every spread we sold. Now, if McEwen Mining, which was trading at $6, I'm sorry, was trading, yeah, at $6, because this is a this was a bullish position. And now I'm thinking we sold the 7 and we bought the 6. And we want McEwen Mining to trade $7.01. We get to keep everything. Now, the way the metrics work, and what I'm going to do is I'm going to go to Paint to show you. I'm going to drop the deck. I really want you to understand what we're doing. And I can do it really quickly. And let's use McHugh in mining. Now, on this spread, it's a $1 wide spread. I don't want this, just want this to be black. So, you're going to asset allocate every position equally. And I'm going to show you how you do that right now. So the distance here is $1. Because it's a $6, $7 spread. Now, we have 45 cents of leeway here. So right here, it's trading at $7. Now, if it trades down, that was convenient, to $6.55, it's right in here, and we're going to make money on this trade. Now, what we've got here, now we still have, I'm trying to think, I'm just trying to make sure that I did this right on the math. Now, if it trades all the way down to here, which is going to be to $6, we're going to take a full loser on the trade. And the full loser is going to be $55 per spread. And if it trades anywhere above 7, we're going to get a full winner at $45 a spread. And anywhere in this buffer zone here, we're going to get some percentage of our net credit. We're going to get to keep some profit, not 100%, but some percentage of it. Now, when the stock is trading in this zone, we can do nothing to salvage the trade. This is called getting middled on the spread, and we just have to watch and hope it either trades above the red line or it falls below this line. If it does, then we're going to have ways to remedy this position and turn it back into a winner. And I'm going to show you how we do that. Now, you can see, let's say that and I'm just making up a number because I don't know the size of your portfolio. I don't know your risk tolerance. That's really a personal decision and up to you. But let's say that you want to take $1,000 of risk per position. You may want to take 500. You may want to take, 150. That's totally up to you. I'm just going to pull $1,000 out of my hat. The maximum loss you can take on the trade is $55. So you're going to take 9 spreads. And those 9 spreads are going to give you about $1,000 risk. If my math is halfway decent, and I actually think it's too low. Actually, I think you want to take 18 spreads, but you're going to take the number of spreads that bring your maximal potential loss to your maximal risk tolerance. So if you get 100%, you're going to get 18 times 45, which is a really, really nice amount of money. And this is how you can turn a strategy that is giving us between 75 and 80% winners without any manipulation at all into a really 45 times 18, that's $810 on that spread. So I'm going to close that up. So I want you to understand the metrics. Now, the narrower the spread, the more configurability that we have. So I like to take $1 wides and $5 wides. Occasionally I'll take a $10 wide, but a $10 wide is only going to give you the ability maybe to buy 2 spreads. And on one of our losers, Lockheed, which I turned into a winner on Lockheed Martin, I took a $15 wide, and I'm never going to do that again. So I'm going to go past this because this is sort of what I already explained to you. When you take a deeply out of the money spread, where you're going to win 90% of the time, there's your 9 winners. All you got to do is hit 1 loser, and your 9 winners are gone. And then if you hit 2 losers in a row, you're hemorrhaging money. You cannot trade far out of the money spreads, and trading in the money spreads is suicide. Now, what I like to do is look at stocks that have cup and saucer. They're called frying pan bottoms, and that are breaking out. And I just wanted to show you a few. This is Cisco Systems. This went on to give us a 42% return. This is really going back a ways. Anterior Resources, 40%. There's that frying pan bottom and breaker resistance and a move to the upside. There's certain, and this has never been looked at systematically, but there are certain chart patterns that have a lot more predictability than others. Frying pan bottoms and consolidation patterns, I think, really have a lot more power than rising and falling triangles. And no one's ever looked at the predictive value per se of every single chart pattern that there is. I think consolidation is the strongest, but also this frying pan bottom that extends out over a course of months just tells us that in here we're accumulating a lot of buyers. We break resistance and we usually get a nice run to the upside. And here's Caesars Entertainment, which gave us 25% return. All we needed was 1 cent to the upside in order for us to garner 100% of our net credit. Now, we're never going to let the trade usually run to 100%. And that's because we have something that's even more important than making money, which is really never discussed. And that is protecting your trading capital. First and foremost, before you can decide that you want to launch out and make money, you have to try the best you can to ensure that you're not going to give any money to the market. You want to protect your trading capital and your assets. So if we hit 75% of our potential max gain, we're going to close the trade. Now, if we hit a stop that's equal to 75% of our max gain, we're out of the trade. Now, no matter where we are on the trade, 14 days prior to expiration, we are dumping the spread because gamma starts to come in, and because we're losing all our time premium, and just assume this is where a relatively small change in the price of the underlying stock makes a big change in our position, and we don't want that. And I'll give you an example of that where I had a trade, this is about 4.5 years ago, where I traded a deeply out of the money spread on Walt Disney. And the day of options expiration, I was up 99% on the trade. It was a Friday with expiration at the end of that Friday. And a brokerage firm came out with a hit piece on it, and Walt Disney took its biggest single fall in its history on that day. Now, it may have taken bigger falls since then, because I'm going back 4.5 years. but I wound up with a $40,000 loser, and I would have traded this and closed it 14 days prior to expiration, I would have walked away with about 75 to 80% winner. So I'm never going to let that happen again. The other thing is the way that we band-aid these trades and turn a loser into a winner requires a little bit of time on the spread. It's very hard to do when you hold these spreads right into expiration. So we're never going to do it. We're going to follow this like it's part of our as if it's religious dogma. We hit 75%. I'd actually go to 80% because we put 80% on many trades. Obviously, we're going to really adhere to our stop. And I've actually pushed the trades tighter into expiration than 14 days. But this is in general what I'm looking to do. I'll bend these a little bit, but this is really optimal metrics. I'm going to skip this. Now, what I have is a scanner. And what I'm going to do is I'm adding to the service. I'm going to send you a scanner report every Sunday night in JPEG form. Now, that scanner report is going to give you the optimal spreads that you can trade based on IV rank. I'm going to show you a better JPEG of it. Now, every single trade that the scanner produces, just like every scanner, it's got an algorithm. It checks the algorithm, and it's gonna spit out trades for you. It has to be vetted. And the first thing I'm going to do is I'm going to vet every trade in my scanner, and then I'm going to look at other trades that are on my hit list in determining what trades I'm going to send out Sunday night. Now, I have in here that I send out 2 every Sunday, but lately I've been sending out 1. I don't want to overload anyone, and I want to give everyone enough liquidity in order to repair a trade. So what we're going to look at is the best performing sector. At the time that I created this, it was energy. We're going to look at the best performing subsector within the major sector, which is oil services and drillers. And I'm going to probably take a stock that's the best of the best within this subsector that is really outperforming all the others. Because remember, we don't need much of a move up. So we don't have to worry that much about a stock being overbought if we're bullish or a stock being oversold if we're bearish, because we don't need much of a move to make a lot of money. We just need it to move literally a penny in our direction, and we're good. Now, I just wanted to show you the open trade we have now. I took it on Vertiv Holdings, and it was a lot of work to find this. Now, Vertiv is a technology company that does networking. I'm not going to go into a lot of the specifics on it, but we got $2 of credit on a $5 wide. So we're looking to make $2 on $3 of risk on a $5 wide. And I'll tell you where Vertiv is trading right now. Looking right at Thinkorswim on my phone. Now Vertiv is trading at 43.46. It's almost $1 above 42.50. So we are sitting really nicely here, turning into the end of November, where we're looking to garner 80% of our net credit. I have an order in to buy this spread back for 40 cents. And for every spread that you took, remember you're risking $300. So if your risk tolerance is 1,000, you could buy 3, and you're going to make $600. It looks very likely that we're going to make, this is going to turn into a really, really nice winner. Now remember, it's never a winner until it's in the bank. but it looks very good for us. Now, I want to show you how we're in the process of repairing a trade, and that's Matador Resources. Now, Matador is one of our rare losers, and who would have thought that energy just would have bottomed out? Now, I think it's reached a point now where it's going to turn around, which is going to be very good for our repair strategy. Excuse me. Now, we sold the 65 put, we bought the 60 put, and we got just under $2. So we round off on a $5 wide. We risked $2. We risked $3 to make $2, and this turned out to be a loser. Now, it fell below that $5 wide. So we had the ability to go into repair mode. Now, if anyone tells you that a strategy they have is simple and easy, it takes you 10 minutes a week, and you're going to make a fortune, blast them out of your computer, because that doesn't exist. That's a holy grail. And if they had a strategy like that, they wouldn't sell it to you. Trading options is hard. It takes a lot of work. It takes a lot of due diligence. But if you do it right, you can be extremely profitable. Now, we lost Matador. So if you just traded one spread, you would have lost about $300 on the spread. That's the maximum loss. But here's what often happens, and this is what traders don't talk to you about. And I want you to understand everything and all the nuance. Now, we're going to go into this at greater length in our educational sessions. So don't think that you have to master it right now. You're going to get an opportunity to get this on replay, only for those of you who attend, and you're gonna get it all. But when it falls through that $60 metric or the $60 price, you're oftentimes assigned the stock. Now, if you're assigned the stock at 65, when Matador, say, is trading at 56, it's no muss, no fuss. If you don't want to hold the stock assignment, you have the absolute right to sell 100 shares of Matador at 60. You can either do it electronically or call your broker. It wipes out the assignment. You own no stock, and you're simply out with your maximum loss. In this case, was $302 per spread. But if you're willing to accept assignment, now that was $6,500 per spread. Now, if you've sold 3 spreads or you've sold 2, you only have to take assignment on 1, and the other one you can simply stick. You can simply call for the 100 shares on the $60 put you own, nullify the 100 shares of stock that you were assigned, and you're out of one position. And you're just sitting it with one, with a $65 price, and Matador may be trading at 56 and 57. Now, what are we going to do about that? First of all, we remember that on this position, we sold the 65, but we bought the 60. So if Matador trades well under 60, that put is going to be worth a lot of money. So we're going to receive 100 shares of stock for each spread sold, but we have 2 options. We can exercise the put, like I said, to short 100 shares of stock, and the stock is gone. Result, trade closed, we're gone. And what I do is, in our core portfolio, if we get a stock assignment, I book it as a full loser, because I'm going to assume that nobody has the ability to accept assignment, and I don't want to build my performance or my win rate off of taking assignment. But I have another section for those traders who are able to take assignment. Now, if you do, you own 100 shares for each spread. The assignment, remember the stock was at 65. We were assigned, I think it was 56 actually. Now we own this, the November 17th $60 put. Now these are real numbers. Now you always wonder, what should I do with that put that I own? Is Matador going to fall further? Should I sell it and get the money that that the put is going to bring me? Should I hold on to it looking for further downside? Well, this takes all that out. You're going to dump the put. Here it was closed for $365 per contract. And then you're going to sell a covered call on the Matador stock you own. Now, this is a little bit of magic recipe that I've developed, but you're going to sell the $62.50 covered call, and you're going to get $75 per covered call. Now, Matador is not a very volatile stock. Don't ask me why the market makers price such high implied volatility into it. Because getting a 40% wide credit on a $5 wide spread on an oil services stock is really, really good. But every month sequentially, we're going to sell the $62.50 call. Now we own the stock. Now the value of only trading blue chip stocks within their particular niche is, I absolutely believe, because I took assignment, is that Matador is going to trade right back to its assignment price. Now, if it does it in 2 or 3 months, I'm not in any rush, because every month we're going to sell another covered call. We've already gotten $365 per contract on the calls on the puts we bought. We're already accruing profit on the covered calls we're going to sell, and we own the stock. So if it lackadaisically moves slowly back up to that $65 price, and let's say it takes 4 months, it doesn't have to get to 65 anymore. It'd get to 61 or 62 for break even. And if it trades to 65, you're going to be deeply in the green. So if you have the ability to take assignment on just one of the spreads, now this is not a buy and hold strategy. We're not holding Matador for the next 5 years. We are simply holding Matador to sell covered calls on. The covered call gives us the ability to sell the put we own and not have to worry about the direction that Matador is going to move. We own the stock and we own the covered call. We're covered to the upside, we're covered to the downside. We're basically in a great spot to be able to take this position and turn it around and make it a winner. Now, I don't have it laid out, but I did this with Lockheed Martin. And Lockheed Martin, really, there was no way to protect ourselves. They came out with news that they were going to only deliver 85 of the 150 F-35 fighters in 2024. They announced that it was not going to impact their bottom line. But you know what traders do? They do it in this market and in every market. They make knee-jerk decisions. So they massively oversold Lockheed Martin. I took assignment at Lockheed Martin when the price of Lockheed was $417 and the assignment price was $455 a share. Now, Lockheed Martin came into earnings and went right back to $455, and I wound up making a ton of money on Lockheed Martin. I'm still holding half. I decided to keep half the stock because I think it's going to trade up to 500 sometime in 2024. Now, I have the money to do it, but if you have a smaller portfolio, and you would have dumped 100% of your Lockheed Martin stock when it hit 455. The trade is closed, you're in the green, and you've turned a loser into a winner, and you've done it in a very methodical way. And I am going to, on a weekly basis, tell you exactly what to do. And you're going to learn this strategy cold. And I'm telling you, in looking at all the different strategies that are out there, this is without a doubt the safest way of building your account in a very deliberate and very low risk way. We're going to trade only blue chip stocks with high implied volatility. And if we get nailed on some piece of news that comes out that we can't foresee, we are simply going to hold the stock. It's going to trade right back to its assignment price. We're going to walk away from it making nice money. Vertiv, I don't see it even, I don't see that as a loser at all. But if it should fall, we can hold it, it'll trade right back up. So Matador is eventually going to trade back to its assignment price of 65. Obviously, I believe that with 99% certainty. So right off the bat, you're going to bank money on the put you own and sell. $365 in the case of Matador. You're going to collect credit on your covered call month after month after month. If Matador doesn't trade up to 65 in 7 or 8 months, doesn't even gonna, we can dump it in the green and not even have to have it trade up to 65. And at the end of the day, this loser is very likely going to be turned into a big winning trade. We're not going to take speculative stocks that can trade from $10 down to $1 and never recover. We're only going to trade blue chip, very powerful stocks that if they slip on a banana peel on some piece of untold news that comes out, they will gain their footing and get back on track. And I think Matador is going to go right through its new 52-week high, just as I believe Lockheed. Can you hear me okay? Okay, good. Okay. I hope I didn't lose anyone, and I hope the audio didn't go off for very long. I'm sorry about that. I'm getting all these blips from Red Light Trading. Now, this is what you're going to get every month. And I hope you didn't miss much of the audio on that. I don't know what happened on that. You're going to get the best trades off my scanner, and I'm going to send it to you in a PDF every single Sunday night. It's going to give you the premium width right here. It's going to give you the percentage. It's going to give you the IV rank. And you can start working with credit spreads yourself and looking for very advantageous trades. Of course, I'm going to send you out what I believe is the best of the best. Now, sometimes they'll come off the scanner. Oftentimes they don't. But the scanner is a very, very nice starting point. And I can't give you the scanner, but I can make Sunday night's trades for the following week available to you in PDF form. So let me give you the offer. Now, I put in 2 optimized credit spreads into your inbox every Sunday, but I'll tell you right off the bat, sometimes you're only going to get 1. It really all depends on what the market offers us. If the market offers us 2 great trades, we're going to take them. But I would much rather not stress out your account. I don't want to overload you with positions. You know, we dumped 4 positions within a week, and we had 3 winners and the loser on Matador. And I know that the loser, and all 3 of the winners made us 80% or more. And with that metric alone, we're trading way in the green. But if you had the ability to take assignment on 1 spread on Matador, we're going to trade that into the green too. I'm going to give you the entry price, the stop, targets, and I'm going to baby you through. I want to spoon feed you the trades because eventually I want to make you very, very independent. But I'm going to give you my entry price, my targets, and as I said, I take every trade. Just hold on for 1 second. I'm getting a text message every 2 seconds, and let me just. Okay. Now you're going to get a lot of intra-week updates. Now, I'm going to try for bi-monthly, but at the very least monthly, we're going to do educational sessions so that I'm going to bring you up to speed on our credit spread repair, how to find the best trades. I just don't have time to bring up, we're just running, because we're running right now at 59 minutes. I was going to bring up Thinkorswim and show you a trade that I'm thinking of taking. I'll go over it with you really quickly. I want you on your own become a master at trading credit spreads, because I believe if you want to now forget the 500% and 600% overnight wins, forget the 900% 1 week wins. Remember, if you take that kind of inordinate profit, you're taking an astronomical amount of risk. So that's what everybody likes to throw at you. You know, I made 600% last night while I was eating an ice cream cone. Well, it doesn't happen. But if you want to grow your account, and remember, it's all about incremental growth. If you can increase your account size by 50 to 75% a year, well, the S&P is up 5% or 6% or 7%. You have beaten 99.999% of all options traders in the market. And I'm telling you, this is one of the most conservative and consistently profitable trading strategies that I have seen. And I have been trading options since 1997. And I still like to trade calls and puts on stocks that are going to make big moves, but I don't believe they're going to. A credit spread is a great way of doing it. The only secret sauce we need, and it's not so secret, is it's got to have a lot of implied volatility, and we have to trade a 50 delta spread. Now we're running a real good special. The first month's only $21 to come aboard. And during that first month, you're going to get quite a few trades. You're going to get at least 1 a week. And if we continue to run, we've been running, you're going to get 3 winners. Hopefully you'll get 4 in a row. Vertiv looks really good, and I'm locked on to a really nice one. It's a little riskier than normal, but it has to do with what's called a Bitcoin halving, and I'm not going to go into it because it's going to be 15 minutes and it's going to be boring to a lot of people. But the amount of money that Bitcoin, the amount of money paid to miners for developing a new Bitcoin is going to halve. It takes place every 4 years, and the price of Bitcoin is gone up 15 to 20% with every 4-year halving. One is coming up in April, and the stock that I'm looking at is looking to leverage that halving. So that's what I'm looking at. It's got an unbelievable net credit of $5.50 on a 10 wide. So you're going to look to make 550 on 450 a risk. I really have hardly ever seen that before. The amount of implied volatility inherent in that position is enormous, but strong bullish tendencies because of that Bitcoin halving. You want to come aboard on the annual at 791. If you have any issues with the service, just feel free to call. I have the number up, but you can go to the website at 786-210-4300. Excuse me, and I'll answer any questions that you have. Hey, Tim, I would like to ask you a question. When I bought from, I think I was the Auto Trader. Oh, no, that Tim, you're looking at the Auto Trader is software that that's not part of my mandate. Right Line Trading has the Auto Trader, but that's not what I use. This is a software-less service, so there's no software associated with it. So you have to call Right Line for that. Okay, Jay, I'm glad you got it back. And if there's any audio that you missed, you're going to get a replay. But for 21 bucks, you get to come aboard for a month, and within that month, you're going to get one educational session where I'm going to spend a lot of time with you working on finding the best credit spreads, trading them, and on credit spread repair. Now, there's a way to actually repair credit spreads without taking assignment. I didn't want to go into it because it's a little bit complicated, but you can dump the stock in its totality, but remember, you can still repair the trade. And I employed them both when I repaired the trade on Lockheed Martin. So I'm going to teach it to you all. So listen, I really, really appreciate your coming aboard and you're giving me your time. I wish you all a very, very happy weekend. And we're coming into Thanksgiving. Have a great Thanksgiving, a great Turkey Day. And all of you, again, be safe and enjoy your weekend. Bye-bye, everyone.